Okay, so here we are in Finance 1031, Week 11, Lecture 2, and we ended last slide deck with variable costs, and I just wanted to remind you, just because a cost or expense goes up or down during the year does not make it a variable cost. It's only a variable cost when the sales increase and the costs increase because the sales increase, or likewise with the decrease. Okay. That's it for that reminder. Okay, now some textbooks, depending on what you're doing, break things up, fixed costs into two different areas. Fixed costs are defined as ones that don't change over the short term. Okay, so over 12 months or less, they pretty much stay steady. And just because the sales goes up doesn't mean the costs actually go up. Okay, these usually include rent, interest, actually interest would be more of a financing cost, sorry about that, insurance, leases, office salaries, property taxes, that sort of thing. They typically don't change regardless of what the sales are doing. Okay, so financing costs, so there would be interest on long-term loans or mortgages, as opposed to operational costs, so just a slight difference. Typically in the small business, we still lump these all in together. Just some people, the financial world, like to distinguish between the two, but if I'm running the company, I'm not terribly worried because I have to pay them all anyway, so I can lump them all in with fixed costs. Okay, now, one of the funny things that goes on is sales commissions. Sales commissions are not considered as a cost of sales or cost of goods sold. Because cost of sales is calculated as a finished inventory available for sale for things you put out on the shelf, or things that are ready for sale, or even if you're doing carpet cleaning, the truck's ready to go. Up until that point, and the goods are actually delivered, the carpet's cleaned, that's called the cost of sales. So the actual selling, apparently, it doesn't really happen, according to accountants, really, until afterwards. So one of those funny things, how accountants just say, well, sales commissions are a marketing expense, but usually a small business owner is going to say, well, if the sales go up and the commissions are going to go up, then basically what we have is a cost of sales expense. And if you can isolate that on the income statement and say this is a sales commission, then yes, I would include that as a cost of sales. But usually it's buried in salaries and commissions, and that's sort of a title on the income statement, so we can't really separate it out. But if it can be separated out, definitely put it into the cost of sales. Now, the way accountants justify that is they say cost of sales happens before the service or product is sold. Sales commissions happen after the service or product is sold, so you pay the salesperson the commission after the bill is paid and after the sale is done. The service business tends to skew that definition a bit, in that you typically get paid immediately when the cost of sales has happened. So bit of a fudge there. Again, if you can separate it out on the income statement, commissions from regular salaries and that sort of thing, I would include it in cost of sales. In some situations, this can be a pretty big expense too. So if we're paying our salesperson, for instance, a commission on the profit, and typically we'll pay them 20 to 50% of the profit rather than of the entire sale, that encourages the salesman to be profitable, to sell things at a good profit. That can be a pretty big chunk of the overhead if you're not careful. So by making it a direct or variable expense, you pretty much cover whether or not your margins are going to be very good or not. Again, we're going to leave it in overhead unless we can see it on the income statement split out, but we're probably not going to see that, just as a bit of a tip. Okay. Now, sometimes in operations we can see things that are a bit variable. Okay, if we're in manufacturing, for instance, our utilities might go up. We'll have a baseline of utilities. We have to keep the doors open and that sort of thing, and keep the place heated most of the time, or air conditioned, depending on the situation, whether or not we're actually making something. So, and that sort of thing will have a baseline expense, but as we turn the machines on, the electricity go up, or the utilities go up, and of course The more you use a machine, the repairs and maintenance go up. So these are some of the things that might have a sort of a straddle sort of thing, or a baseline where the part of it will just be fixed and the expense won't go up or down no matter what. But then another part of the actual line by line expenses will actually increase or decrease. These are semi-variable costs or expenses. And again, we're not going to see that in this course. There's entire courses developed for that sort of thing, but we're not going to do it. Be aware, however, especially maybe in a test situation where we're going to write a test, that it does exist. Okay, the other thing that comes up in conversation is amortization. One of those things that can be included in the small business calculation. We will look at the expense or the costs involving break-even without the amortization or depreciation expense calculated. And this is something we tend to do with when we're just doing things on the fly in the back of an envelope or whatever the case may be, and trying to figure out our costs. Typically in a full-blown spreadsheet situation, we will include it because rightfully so, we're trying to match our expenses and our revenue. So typically for what we're doing in the course, we'll include amortization where it's available. In real life, we tend to not calculate. We just go with the cash-based sort of thing. Okay, so the break-even point, that's the exact sales volume at which the business total revenue is equal to its total cost. Okay. At this sales volume, the business does not earn a profit or it does not suffer a loss. Basically, it's zero. Okay, but kind of like I tell students, if they're shooting for a 50 in the course, kind of like shooting for break-even in business, guarantee you'll lose business. Shooting for 50 in the course, guarantee you'll fail the course. Okay, so we don't really want to run our businesses with break-even as the goal because it just doesn't work. So keep that in mind. So break-even is a point where you don't earn a profit or you don't have a loss. Now, there are a few ways to calculate break-even, and we see either one quite frequently in business. Okay, so it can be calculated in dollars, i.e., do I have to sell $100,000 before I make a profit? Or do my sales have to reach $50,000 before I make a profit, i.e., up until then I have zero profits? Can also calculate it in units. Okay, do I have to sell 10 units to make a profit, or do I have to sell 1,000 units to make a profit? And these are the questions that really come into play. The units, especially when you're talking about selling things into a limited size market. If you're only going to sell 10 of them, then you have to have a huge profit to survive, to put food on your plate. If you're going to sell thousands of them, then the figurations get a little different. So this is what we try to figure out with break even. If I sell X number of dollars, I'll make a profit, and of course, side issue, how much? Or if I sell X number of units, will I make a profit? And of course, how much? So these are the questions we try to look at with break-even calculations.